Good morning, everyone. I'd like to call to order the Audit Committee meeting of the City of New York for February 26, 2025. And I'd like to have the secretary do a roll call.
Good morning, everyone. Our private members, Michael Spitzer, Chair,
Present.
Larry and Angelo, Mark Kaplan, Marcia Van Wagner.
Present.
Our public members, representing Mayor Eric Adams, Sarah Wong.
Present.
Representing Comptroller Brad Lander, Jacqueline Thompson.
Present.
We have a quorum.
Thank you. At this moment, I'd like to turn the meeting over to the secretary.
We want to take nominations for Chair.
I nominate Mike Spitzer.
Thank you. Michael Spitzer is the Chair.
Thank you, everyone. Next item on the agenda of business is a nomination for secretary, and I nominate Katrina Stauffer.
Second.
Thank you.
Okay, the next item, what? Is that being recorded? Thank you, everyone. And next item on the agenda is to accept the annual report that has been furnished to us by the secretary. And it's the, yeah, I'm going to do that later. Get rid of all the administrative stuff first. And the annual report was furnished to us once again by the secretary, and it records all the activities that we did in the prior fiscal year of the audit committee, which ends, like right now. So I'd like to have a motion to accept the annual report as written. And if you have any nits, please just, if they're not serious, we'll just furnish them to the secretary.
I moved it.
Thank you. The next item on the agenda is the approval of the bylaws for the committee. And once again, these bylaws were written and revised in '91. They were originally written in the early '80s. So, I'd like to make a motion that we accept the bylaws as written. Thank you. And next item on the agenda is the acceptance of the minutes of the audit committee held on January 29th, 2025. Okay, are they serious? Okay, we'll just furnish them over to the secretary.
Turn it over.
Okay, the next item on the agenda is the financial statements for the Health and Hospital Corp. So please identify yourselves, your auditors, and anybody that might be on Zoom. And that's for the purpose of getting it all into the minutes. Yeah, where the buttons and push, there was a change. Yeah, you got a cramp in your finger.
Hi, I'm James Linhood. I'm the Deputy Controller.
Joseph DeBray, I'm a Director of Accounting and Finance.
I'm Timmy Diallo, Deputy Comptroller.
Okay, and I'm also joined here by our independent auditors, KPMG. To my left here, I'll recognize them for introduction.
Great. Hi, good morning. I'm Maria Tiso, the lead audit partner from KPMG.
I'm Ryan Santanacita, Audit Managing Director, supporting Maria.
Okay. And we are joined, I believe, on Zoom by our team member, Nicole Fleming. She's a Director of Finance at H&H, and Anna Bias, who's actually my assistant, is on the Zoom as well, so I want to call that out. So we are presenting today the fiscal year 2024 financial statements for HHC. Certain things I just want to note at the outset here. We are obviously joined by KPMG. If you recall, last year, our independent auditors were Grant Thornton. So we did transition in fiscal year 24 to new auditors, KPMG. So it's been a great collaborative effort with KPMG. It was a complex transition, but I think we, got the job done, and we're grateful for their partnership. I also want to note for the committee that there is a single year presentation this time around. I don't know if you guys noticed it, but we'll get into a bit more as to the why we're doing a single year presentation in fiscal year 24. But it relates to a matter that we'll discuss further as we talk about the management letter. And, it was a combination of a legacy issue that was from about 6 years ago and something that happened the prior fiscal year that kind of brought about the matter in question. But we'll cover it during the management letter discussion. So just some quick overview about our performance fiscal year 24. The income statement showing operating revenue for HAC of $15.9 billion and a total operating expense of $15.2 billion with an operating gain of $623 million. For key drivers in terms of our performance, I'm going to turn it over to Joseph DeBroja to walk us through the details of the income statement.
Good morning. Our income statement you can find on page 15 of the financial statements if you have a hard copy. Not quite sure what it is on the PDF. Page 17 on a PDF. As David mentioned, we finished fiscal year 24 with a maybe
Move it closer to you.
Closer? Okay. So the income statement is on page 15. So it is a single year presentation. However, we have the financials from prior year. So we were able to perform variance analysis and provide you guys with some highlights that impacted each one of the income statement line items. No? No?
Can you just try to move the whole thing closer to you?
Okay. Better?
Yes,
Okay.
for now.
Okay. So I will start with operating revenues. Net patient service revenue is made up of both patient service revenue and our third-party retro receivables and revenue. Our revenue, patient service revenue increased $430.8 million. Retros decreased, which is DISH and UPL, by $360.6 million. However, we saw a lot of increases in risk pool dollars, both from Metro Plus and other managed care plans. Appropriations from City of New York increased $1.2 billion. It's due to the appropriation for HERC, or Humanitarian Emergency Relief and Recovery Centers. Premium revenue is a Metro Plus item, and premium revenue increased $166.7 million in FY24. Grant revenue. Grant revenue increased $414.7 million. We saw a test and trace decrease of $176.1 million. However, we did have an increase in COVID FEMA grant revenue of $356 million. And for the very first time in FY24, we recognized $41 million for behavioral health centers of excellence related to COVID. Other revenue decreased $37.3 million, and that is mostly due to 340B pharmacy receipts. Do you have any questions on the operating revenue side? Or
Yeah, the appropriations from the city jumped by 1.2 billion.
Right. And that's predominantly for the HERC program in FY24.
The which program?
Humanitarian,
Okay.
emergency relief, and recovery centers. That's the funding for the entire program.
Is that better? Oh, yes, it is. Okay, so it really is complex. Could you just quickly remind me UPL and DISH, what they are, if they interact, and are they federal or state?
Dish, talk about that a little more.
So yeah, DISH is, I think they're both federal and state components to both, right?
Okay.
And they do kind of, there's interplay between both of them. DISH relates to uncompensated care, and UPL is kind of compensating us for providing care that's above, well, the funding is not meeting the cost of the care, but there is interplay between the two. Because, you know, a lot of what goes into kind of how we get the dollars relate to what our payer mix is, what percentage of our payer mix is underinsured or uninsured totally, or Medicaid based payer mix. So it's kind of a complicated relationship between the two.
And what percentage is from the federal government, what from the state?
That's
Roughly.
Yeah, it's a good question. I think it's half, 50-50, but I would have to really look at that a bit further. I don't have the percentage.
Thank you.
If you guys,
So just to clarify, you're saying that the FMAP for those programs is like the same as the FMAP for everything else?
I rather
Yeah, you
kind of
don't know.
take a,
Okay.
yeah, let me
All right.
take a look at that. I'll get back to you, because I don't have the percentages in front of me, and I don't want to misspeak.
Please, if you get back to
Yes.
Katrina, and she'll forward it to all the
Okay.
members.
well, where are we, and what note, on what page?
Outcomes for various appeals are not presently determinable. No provisions have been made.
Is that note 12A?
Find it.
Yes.
12A, yes. It's on page 48.
The third
Third
paragraph down
paragraph,
towards
last
the
line,
end.
Last sentence. I guess is sometimes that can be a big number, but you're not willing to take any position on it.
Not able to find that.
You see it?
It's,
I understand what you're saying. I just don't think it's a way to say it.
You found it?
you found it?
52.
Because I'm sure someplace in
another
the
way.
organization, the lawyers who are dealing with the cases have a view of what their liabilities are likely to be.
I,
Feel free.
Can you hear me?
Yes.
Great. So typically in the healthcare industry, you don't record appeals because you don't have enough information to determine what the actual settlement will be. And that's just typical in the healthcare industry across the board. And then
Okay.
from a liability perspective, a liability would get recorded if the balance is estimatable and probable.
Well, I understand the language.
Exactly, but on the receivable side, exactly. So typically, in accordance with the accounting literature, if there's an appeal out there, you technically don't record it until you actually get correspondence that you're going to receive it and it's been approved. Yeah,
Okay, that's,
yeah, yeah. And it's really, like, the accounting is for gain contingencies, so that's how it's treated from an accounting perspective.
now, if you really want to pick your own one, the name of the city of New York is the capital V, and you go in different places, different treatment. But just so that somebody read the papers, you should next
Yeah.
time around maybe capitalize all of these.
Yeah, we actually looked at that because I know you mentioned that the last time around. And we looked to the city's ACFR as the gold standard. And when the city refers to the state, it's also lowercase as well.
The only difficulty is the official name is the capital letters T. All right.
No, Nicole says no.
Does anybody else have any questions or comments besides, is Mark still looking?
May I?
Yes,
Thanks. Page 62 of the financial statement.
page 6-2.
62.
What note is that again?
18.
18.
Just a couple of quick questions. It's 1.52 billion spent on asylum seekers cost, but only 1.3 appropriated by the city. And why is that? Whether that amount is still, the difference is still that large, and what is the amount for FY23?
Okay. So, correct. So we received in FY24, we received 1.276 billion in cash from the city for HERC. Our revenues and, it's a matching principle, so whatever is an expense is also in a revenue, is 1.5 billion. The difference is a receivable from either the city or if they were any federal dollars or state dollars, those would be reported as grant receivables. So yes, you are correct. And, the difference is the receivable still. In 23, we ended, that was the first year of HERC, I think, 23. At the end of the year, 6/30/23, we had a receivable of 89 million. Since then, I think the city and our HERC team have been working on reconciling the 89 million, and we have received 16 million out of those 89 million. So I think they're still working on finalizing the numbers. But yes, we still do have a receivable from the city.
So we issued a request for information to H&H, for which we have not received the answer yet. Are you aware of our request for information about?
Yes.
Yes, we are aware, correct.
Okay.
Yes, I believe they're working closely with OMB and getting what you guys are asking for.
Correct, because this is very much a partnership with OMB. So I think there had been discussions on this RFI, from what I understand, behind the scenes with OMB to get you that information.
There is not a lot of amount left. There is 73 million for FY23, and I understand that it's about 50 million for the FY24 amount. They are about to, at least they told us, but I guess they didn't tell you from your look. The OMB is going to liquidate about 196 million in the next couple of weeks, right? We would very much appreciate having an understanding of what expenses are still outstanding, whether you're still waiting for invoicing, whether there is a chance of those accrued expenses that will be taken down. So the other question I have is the FEMA grant. As you know, there was a highway robbery, and FEMA took back 80 million that were given to the city. This is a separate grant from the SSP that was given to the city. Is that right?
What was he referring to?
There's FEMA grant revenue of 96.3 million.
Is that on, where is it on the financials?
Oh,
You're
the
talking
same
about-
note.
It's on the
under
note.
HERC note.
Yeah.
Is that a separate grant?
Man, would you know?
Separate grant from what?
From the city's SSP.
I don't think we know that.
We don't know the nature of the grant.
Has H&H received any notices from the federal government regarding pauses or interruptions or rescindment of existing grants or money that you consider that you build the federal government for?
Not that I'm aware of.
Thank you.
Just to add, sorry, for the SSP grant that's noted in their financials, they're a pass-through of the city. So the city OMB is the recipient of that. But if there's any additional questions, we could definitely get your answer for it.
Sorry, say that again. I didn't catch that.
So they're a pass-through of the city. So the city is the direct recipient of those SSP grants.
Okay, so whatever, 237 million. Well, yeah, that's the FSP and SSP. That's
EFSP,
part of this 96.3 is part of that amount.
it's part of the SSP grant, yes.
Yeah, and that receives this. So if they don't pay the city, then there is a.
So yeah, this
there is a
amount over here,
repercussion on
96.3 is EFSP and SSP, sorry.
Sorry, we were talking on top of each other.
Yeah, there was two grants from FEMA. There's the EFSP and the SSP.
That's right.
Mhm.
But the federal government has taken back 80.5 million from SSP, from the city of New York. Plus there is another about 37 million that has been suspended so far from SSP. That's my understanding at least. So these actions from the federal government could impact this 96.3 million because that's money that would flow from the FEMA to the city to H&H.
I'm not too sure if there is any actions taken for this 96.3, but we could definitely go back to OMB.
Okay, that would be great if we could.
Yep.
Thanks.
Are there any-
I have a couple of minor questions. There's a reference here to SBITA's liabilities. What is that?
Those are the subscription-based software leases.
And there's something referred to about a Change Healthcare breach. What was that?
So you may recall in the news, there was some issue affecting the company Change Healthcare, and that was our clearinghouse at the time, the H&H clearinghouse, as well as other healthcare providers. We don't know exactly the nature of what happened in Change Healthcare, but it disrupted their operational flow and affected our work with them as the clearinghouse. Fortunately for H&H, we actually were in the process of transitioning to another clearinghouse, Experian, which we actually did transition to Experian, so we kind of moved away from Change Healthcare.
So the breach is something having to do with the performance by these other people?
I think it was more of an IT-related breach, but I can't speak to what Change Healthcare experienced, their company, but there was an issue that they've experienced with their application that affected workflows that we have established with them and other healthcare providers nationwide. They couldn't process our claims and remittances coming back to us. So there was a disruption there for quite some time. We had to take mitigating action.
Does that mean it was not only disruption, but some costs associated that you ultimately had to write off?
I would say that there could be potential costs in that staff had to work overtime, like billing staff, and to kind of employ countermeasures. So there may have been some kind of marginal costs associated with this. I could check back with our organization's budget.
I'm just curious.
Yeah, but we actually did pretty well, I think, recovering from this disruption, which really affected our revenue cycle more than anything. And payments stopped coming in, but we did have agreements with payers to they kept floating us dollars while everything was kind of corrected. And when we look at our financial performance on the collection side, we don't see that it affected our collections, thankfully, from a denials perspective.
I look at the page 7, it refers to the accrued expenses and payables increased as a result of cash flow management. So due to increase in various accrued expenses, that in effect means that you're slowing down the rate at which you pay.
Right, but that's just overall cash for the entire organization. Change Healthcare affected just our patient service revenue cash that was coming in.
Last question, just because I didn't know what it was, is a reference to OT times HU project,
What page is that?
page 7. I'm just curious what the letters say.
Mark, on page 9 is the full explanation of capital projects, large capital projects. The OTXU is one of the large capital projects. Presumably it's an acronym. It's not defined. It's referred to as OTXU. We can circle back and next year see if there's a definition for the assumed acronym. But you'll get a fleshed out explanation of what the capital project is in that that section.
Okay, thank you.
There also seems to be two different versions. Our page numbers aren't mapping to your page numbers that, like you state.
Well, I just said page 9. It's hard copy page 9 in
It
the
is page 9, but we have it on page 8.
page 8.
And like there was
In your
also
printed?
differences with the income statements, like you had said, a certain page, we have it on a different page. So I don't know, like why. Okay.
No, I think
So you'll have
each
to
page
provide
has a
us all
number
with
at the bottom
iPads,
of
is
it.
that what you're saying?
I think each page has a number at the bottom of it. I think we're pretty saying.
Yeah.
Are there any other questions?
The other thing, of course, is if you look at the city, it's better capitalized.
We're aware that you made the note earlier in the presentation.
I'm a perpetual nudge that way.
To the management letter then?
So I'll recognize our partner, Maria Tiso and KPMG, to discuss the management letter.
So I just wanted to say a few comments. So we met with the audit committee on October 22nd and went through various required communications. One of the required communications is that we did issue a material weakness in the management letter relating to the opening balance restatement from 2023. So as we were performing our opening balance procedures, we did note that the OPEB and pension liability related to deferred inflows were overstated by 212 million and 111 million. There was certain adjustments made by the city actuary that historically happens. But when we looked at the adjustments collectively, they were over our materiality threshold. There was also a new GASB that was issued, GASB 100, which talked about accounting changes and corrections. So putting all those facts together, management had to restate the opening balance. So the reason for the material weakness is because the adjustments were over our materiality, and we felt that the internal controls and the precision over reviewing those areas could have been more precise. So we materials and that reason for it.
So I just want to, can I expand a little bit?
Yep, sure.
So we kind of worked together to understand this matter, and there are two components to it. One of the components relate to something that actually happened about 6 years ago, and it relates to the actuarially calculated liabilities and information we got from the actuary's office. I believe in 2019 we were made aware that there was an error in 2018 in the numbers that we used and were provided to record our financials in 2018, the pension and OPEB, information. And since there was kind of no alignment in terms, they changed their report, right? But on the financial statement side, we didn't have that information until we got that report. So then my predecessor at the time spoke to the auditors and asked for a restatement. The auditors at that time felt a restatement wasn't necessary. So they came up with a method to kind of to control for this anomaly in the financial statements and carry that forward throughout the fiscal years that Grant Thornton was our auditors. That was one component. And then another component related to an issue that I believe arose in 23. There was an error in the numbers that we received that we didn't really detect. We thought that we saw a kind of a variance, but we thought it was the implicit rate. And but when we delved into it, the variance again occurred in fiscal year 24 at a larger, more higher magnitude. We started questioning what was going on, and we worked with the actuary. Actually, the team here knows this better than I, but they connected with the actuaries and figured out that there was an error, and it affected 23 as well. So the two things together kind of coalesced into the adjustment that KPMG is noting. And I don't know if you want to get into, Joe, a bit more from your perspective. I know you guys worked with the actuary to detect the latter issue.
Sure. The latter issue was related to OPEB, or other post-employment benefits, and it impacted deferred inflows. What the actuary did for that 1 year, the actuary included Medicare Part B payments as OPEB-related payments. Therefore, they lowered our OPEB liability by that amount. And on our end, we just saw it as kind of like an implicit rate subsidy of a sort, because we always kind of account for it as that. It turns out it wasn't, and we were kind of in conjunction with the actuary. We spoke with the actuary, and he said that's exactly what happened, and we've made the subsequent adjustment to the financials.
So I have a couple questions because I'm not quite sure I understand all of this. So for the first part with the Grant Thornton error, whatever, so you're saying your predecessor corrected for it or didn't correct for it? Like he said it was over like a multiple year. So was it phasing out the mistake, and did that have some cumulative impact on the total amount at the end of that phase out period?
Yeah, so I think what he had asked for was a restatement at the time, and the audit firm at the time declined to restate. They felt I guess it was immaterial. But they, in conjunction with the CPA firm, they found a way to kind of account for that adjustment on the books. But I believe it was using deferred inflows and outflows to control for it.
So they controlled for it in a different location in the statement?
Correct.
Okay, so the numbers at the end of the day tied, but they weren't tying in the right way. Okay.
Right. The expenses were what the expenses were as per the actuary, so they were correct. But the deferred inflows are on the balance sheet.
The issue of why KPMG took issue with it and Grant Thornton did not is because, as you're aware, with actuarial valuations, they kind of compound on each other year over year. So what happened was essentially the dollar amount of what was reported in a different line than it should have been kept growing over time. So it got to a point where the level reached a degree where KPMG was uncomfortable with what the number had become. And so they took efforts to have us essentially correct where it should have been reported in the first place, which is what we had initially sought with our previous audit firm. But because at the time the number was considered immaterial by our previous audit firm, we weren't, they had declined for us to restate our financial statements to put it in the appropriate line.
Okay, all right, thanks. So actually more. So on the second issue, it sounds like you were getting numbers that were, so this Medicare Part B thing where they included that. So was that then, do you know if that was reflected? Like if, I don't know how to put this, if the actuary was moving that into your numbers, was it being taken away from somebody else's numbers or from some other place in the reporting ecosystem?
Yeah, that that we can't answer
Yeah,
that.
that's a
That's
good
just
question, though.
actuaries' work
Big
papers
question.
probably. But they did end up giving us more credit than we deserved on the OPEB side.
And just to Mark's question earlier about what OTXHU stands for, it's Outpost Housing Unit is what it stands for. It's for care of inmates under the Department of Correction. The note itself on hard copy page 9 speaks to more detail of what it actually is, but that's what the acronym stands for, Outpost Housing Unit.
You had also stated when you started, there's only a single income statement, and you would go into why.
Right. Yes, it's a single year. Because of this issue, we had to restate the opening balances. But we reached out to the prior auditors and they kind of declined to partner with us to do that. And so I think the fact that, we have new auditors kind of made some complexity around this issue that we probably could have addressed. So we opted to do the single year financial statements because we couldn't touch the prior balances.
So Mike, to that end, GASB had recently issued a new standard that changed the way that you needed to report accounting errors. Whereas prior to the issuance of that new statement, there was a little bit more wiggle room for reporting errors in financial statements. They now mandated that if there was an error in a prior reporting period, that you needed to report a single period presentation.
Also, just to clarify, we couldn't issue comparative because we weren't previous year's auditors and we couldn't rely on that information. So it was because of the new GASB standard, it was, that's why we did the single year.
But the MDA has both years.
Yes. So in an MDA, you can do comparatives because we don't audit the MDNA technically. It's unaudited.
The
Right.
standards require the MD&A to be comparative. So
Exactly.
if you have 2-year presentation, you have 3-year MD&A. If you have 1 year, you'll have 2 year.
So does this mean like next year we'll be getting a 2-year presentation?
Yes, so it'll be comparative
to
because we're the auditors for both years. And then you'd have the MD&A would have 3 years.
Correct.
Yes.
Okay. Any other comments, questions? I'd like to thank you for coming here this morning and good luck in this year's audit.
Thank you.
For the record, I just want to announce that our Public Advocate Representative Matthew Carlin is present. Thank you.
The next item on the agenda is the New York City School Bus Umbrella Services. Does that mean we all get umbrellas? Well, I want to know if we're getting umbrellas. just please make sure all the microphones have the lights on. If they don't, just hit the push button. And please identify who's here and who might be on Zoom so that we could get everybody's name into the minutes.
Angela Mayo,
Uh,
I'm the director of budget.
Okay, and all your titles for the,
Matt Brennan, I'm the CEO.
okay.
Sujit Sira, BTQ Financials. We do the finance and accounting for Nice Bus.
Stephen Lee, Audit Senior Manager for Nice Bus.
I'm Jim Wilkinson. I'm a managing director with CBiz and one of our governmental industry practice leaders.
And I'm Warren Rupel. I served as the engagement partner on Nice Bus this year.
Yeah, I notice it says your team.
I couldn't find a good background, so I used this one.
Could you like please make a presentation of like the financials?
Okay, yeah, I mean, we didn't prepare a PowerPoint or anything, but I mean, I can briefly describe Nice Bus as a not-for-profit school bus company. We were founded in November of 2021. Founded a year earlier, but we started operations November 1st, 2021. We operate this year 772 bus routes. That number varies, about the same number last year. It varies week to week. Out of 6 depots across the city, the bus routes run all across New York City. All the kids we transport, oh, sorry, I'm not going to talk about the right one. All the kids we transport have IEPs, so they're kids in special ed. We have about 1,800 employees, revenue of about $190 million. We reimburse directly by the New York City Public Schools costs. So while we might have revenue and expense on our balance sheet, really we are, as you know, functionally integrated into the city. Really our only source of revenue in the past year was city funds, though we've been quite successful with federal grants and that, and by electric buses, that will start to appear on our balance sheet. We've also been pretty successful with grants from New York State. So we do a very small amount of private work,
All the bus routes basically challenged students.
The kids with IEPs, kids in special ed.
Mm-hmm.
And was that determined when Nice Buses came into existence? I mean, was it intended to be for kids with IEP?
I mean, I don't know. Our contract with the city. So we do have a contract with the city of New York. Technically, I guess it's with the Board of Ed, which is maybe a separate legal entity. Right, but I think legally it's with the Board of Ed, which is operated by the Department of Ed, which is now called New York City Public Schools. And that contract is to provide specific bus routes that are special ed or IEP. I mean, I think the Nice Bus could operate buses for kids in the general ed population. There's nothing in our bylaws that prevents that, but our contract only has us do not only just kids with IEPs, but there's a, Larry and I were joking before, I can go on and bore people about school busing ad nauseum. There's specific routes, specific geographies, and specific kinds of equipment that we have. So within Queens, big buses, we have a contract for some of those. But we don't have one for within Manhattan ramp wagons.
I think you should just be aware that this committee has a very high tolerance for boring topics.
No, I realize that. Larry and I arranged for maybe talk some other time about school buses.
So let's have more detail. No, but actually I do. So what percentage of the kids with IEPs are you busing?
About 10% of the kids with IEPs.
Okay.
I have a financial question, and that is you say on footnote 3,
Page 22.
you have uncollateralized liability for cash in banks. And why?
So
you don't even say that it's with a creditworthy bank, which some people like to say.
So it is with a creditworthy bank. So, the smart aleck answer is it's the city's fault. So we have maybe 3 groups of deposits would be a right way to say this. So our main operating deposits are collateralized with a bank. I don't think I should say the name. It is a large bank in New York City. We have 2 escrows we have 2 escrows. One of them is a relatively small, few $1 million for an insurance policy. Basically, we put aside the money so the insurer feels more comfortable if the losses are higher that they could draw on that escrow. At the time of this audit, that escrow and that policy was going to expire, and I'm going to forget if it's October 1st or October 31st of 2024. Our board decided, I think rightly, rather than renegotiate the insurance agreement, let's finish that insurance agreement. It is with a great big bank, and it's uncollateralized, but silly to kind of renegotiate the insurance agreement. And then now that one is gone because we renegotiated the insurance agreement. The third deposit is a escrow related to the purchase. So this company was created by purchasing the assets of another bus company.
Button on microphone for the people on Zoom to hear.
Oh, hi. Sorry. Oh, hey, everybody. The third escrow is related to the purchase of the company. So we escrowed funds to ensure the completion of the transaction. The city of New York, frankly, arranged for an escrow agent for us, again, with a large New York City bank. On advice of counsel, we are not going to reopen and move that escrow. We could, right? But we need agreement from the people we bought the bus company from, and that would give them some hold-up value. So it was just, the board judged, I think they were right, that, moving the money somewhere, and the bank that we have it in won't provide a collateralization service for that.
And just to add to
Angela might have more.
that, that pension escrow is actually a joint account with the ATU. So we cannot single-handedly just move the money for that. That's
I'm
the
accustomed
only.
to where they're not collateralized.
What?
I'm accustomed to seeing that in some language that says that the bank with which holds the pros, whatever it is a big, safe bank. Something like
I don't know. I mean, the auditors can tell us why they didn't give us that language, why they didn't write. Steve, why didn't you say it was a big, safe bank?
It's not the, when we were crafting the footnote, we were kind of trying to capture, that there was some money at risk. And we didn't include anything regarding the actual institution it was in. But overall, we were just trying to capture the premise that there is
I
some money.
understand, but I'm accustomed where there's uncollateralized a statement that says that the company is satisfied with the credit standing of the bank, or something like that, rather than just saying nothing.
Yeah, I think it's now with kind of having this discussion, I think prospectively there'll definitely be something to include in that footnote.
Now, a most important part of this whole conversation is the paragraph that you have at the end that says that you can't do this, it can't be used by anybody other than the board of directors unless permission is granted. That's at the end of the letter. Do I assume that this meeting means you granted us permission?
Are you talking about our
Mark,
management letter?
If you look at the CBIC letter, the last paragraph says it's solely for information of the board of directors, the audit committee, and it not be used by anybody other than these specified parties. Clearly, that's wrong.
Are we talking about the management letter?
Oh, so is this in regard to
You're
number
right.
3?
Management.
No, he's in the management letter, I think.
We were told, so we did ask the committee, so I certainly have a different view of management letters than you might. I think management letters, it's healthy not to frankly share them with outside entities, because it prevents it in some ways can inhibit a honest appraisal from the auditor who's just saying to management, listen, like if someone, figures this stuff out,
Yeah, but
And so in an email exchange, I made sure to get an email exchange from someone at the controller's office when I said, we'd rather, as a sort of matter of policy, we'd rather not share a management letter. And I was told we had to, and I of course assumed that that was the right thing to do. But I did manage to get something in writing that clarified that we should share that with you. And obviously that's not.
So Mark, maybe I could address this because this has come up in the past. When this language is not for a standard audit report, so we're required to restrict its use. And the Auditing Standards Board, which sets auditing standards, took a look at the situation where you have reports that become public. Should they still have this limiting language? And their conclusion was that it should. So that's why it's there. We're kind of required to have that.
Well,
With the acknowledgement that it becomes public once it, they have it on, well, not
look,
on
we
the
are looking
website.
at the audit committee.
Right.
And the language here says we can't do it. You shouldn't have given it to us. Other than those specified parties unless permission is granted. Am I assuming that the fact you're here?
Yes, you have permission to look at the letter.
Okay, so that's what I wanted to hear. And I tell you, every time this has happened in the past, I have taken the position that an audit is an audit, and it, in a public context, and this should be public.
Yeah, I mean, I don't know enough about the American Society for Certified Public Accountants standards for management letters and things to be able to opine about that. But certainly you have permission to look at the letter.
Make sure next time you give us the permission to issue the letter.
Okay. Great. Yes, I will do that.
Quick question, I believe you answered it. You do have an audit committee, and how many members are on it?
So our board serves as the audit committee. We just have a 5-person board, and the board serves as the audit committee because the board is small.
And is the board employees of NICPUS?
No, the board is, so 4 of the board members are appointed by the chancellor of the New York City Public Schools, 1 by the.
So they're independent people?
Pardon me?
Independent?
All
people.
independent, yes.
Okay. And I also noticed that your contract expires a year from now, June 26.
We've noticed that too, yes.
Mm-hmm. And are there any federal funds on here? Basically, with everything that's going on within the federal government, and they're all looking at grants, could there be an impact?
So I don't know if there are any, I mean, I can talk, not right now. So there are no federal funds in the 2024 audit. There are federal funds we've received, which I'm happy to talk about. They are outside of this audit, but it is a significant issue that we are facing.
Mm-hmm.
And I don't know if you want to talk about that. I don't know if it's appropriate to talk about that.
It's like, basically, the city could be getting federal funds that are paying you.
Well, so there might be, I guess we don't know if there are federal funds. We just, get a wire transfer from the Board of Ed. We don't know if there are federal funds in there to the extent that, but then in addition, NICPUS is the recipient of 4, 5 different federal awards. I don't think any of those are on our books as of June 30th, 2024. And they are a significant, and the what's going on in Washington is a significant issue for us and should be to the city.
Do you get the ordinary transportation money that the city buses get from the state?
We don't, again, I don't know. So I don't know in the sense that you'd ask me what I really, really know. I do not know for sure what the source of the money the city uses to pay us is. I am pretty sure from my time at New York City Public Schools and at the Board of Ed that there is no city transportation funding in that from the feds, from the FTA or something.
No, not from the feds, but from the state, right? Because there's the state transportation money.
So that, again, so we're now sort of, I am speculating, but I think I'm pretty sure, and this is sort of in the word of discussion, I am almost positive that when the city of New York pays us $100, they go back to the state and they say, look, we spent $100 on busing, and the state's reimbursement formula is very complicated, but it's roughly half and half, and the state of New York writes a check for $50.
And you count within that even though you're a separate entity?
We don't know anything about the source of the money, and we just count that as revenue. We don't know where Mayor Adams gets it, whether he gets it from the governor or not. Just like any other, just like if we, I mean, we are a private corporation, and we don't, you know, where it comes from doesn't, yeah.
Yeah, I have a quick clarification about that comment, about the collateralization. You said that you're a private corporation, but you're a component unit.
Well, I just meant we don't. I mean, we are. Yeah. Yes, we are a. I mean, legally, we're a 501c3. That is, I guess I don't understand the legal. We are certainly a component unit of the city that consolidates with the city of New York because our board is appointed by people ultimately who report to the mayor, and because the plurality of our funding comes from the city, and because we provide a service almost exclusively for the city of New York.
Okay.
Nonetheless, we're organized under the state's nonprofit corporation law.
My question is a little specific because there is a General Municipal Law Section 10 that requires collateralization of bank deposits. So if you could, at your convenience, let the audit committee know why you would be exempt from GML Section 10.
Oh, right. I didn't mean to say we were exempt. I just meant to say that we, frankly.
Okay, let me rephrase. They're uncollateralized deposits.
Right.
There is a GML Section 10 that requires that governments have collateral above the FDIC amount. So the question specifically is the fact that the deposits are not collateralized in contravention of GML Section 10. If you could clarify that for the audit committee.
I think it is.
Not immediately. Okay.
I mean, I think so.
All right.
Like, I think,
Okay.
I think it is.
For the record.
Just if you can look into it and then
Sure.
get back to Katrina Stauffer and she'll let
Will
the
do.
committee know. Okay, thank you. Are there any other questions regarding the financials? Then I turn to the management letter. I noticed several comments repeat year after year and what's going to be happening about them.
Let's see. So to me, the one that's most significant is the lack of approval of overtime. And so overtime is approved. The problem is it wasn't properly documented in our financial system because there wasn't a place to do that. So we've done two things to solve that problem, which is now solved. One of them is that we've built a workaround so that we now have approvals of overtime. And the other thing that we've done is we've set up a pre-approval process so that we make sure overtime is approved in advance. That is there for 2 years, bad, right? So I'm not, that is a significant, I mean, I guess it didn't raise to the level of significant, but that's certainly something that is not appropriate and wrong, and we're embarrassed about that.
So you're basically saying comment one's going to go away.
Comment one is
It's going to
gone,
go into the
yes.
bucket prior years,
Yes.
but resolved.
Yes.
Number two, the investment policy.
So the investment policy, the board has approved an investment policy.
You're saying this one will also.
Yes.
I think it is noted that the investment policy was adopted. This really is more on the.
Yeah, but
on the
this
collateral.
is really the auditor's report, so
Yeah.
I just want to be ensured.
You're exactly right to do that.
Yeah. So in the initial year, back in 2022, when the initial observation came out, it was for both the no collateral agreement and the adopted investment policy. This year, we were able to receive that board-approved investment policy, so that was cleared before the 6/30/2024 report was even issued. The only thing remaining in number 2 had been in regard to the collateralization in excess of FDIC limits, discussed in note 3 of the financial statements.
And number three,
That's the reimbursement.
My family and I would like to get the reimbursement. So there is the board, so there has been no reimbursement made to me. So I'm owed, I think it's sort of $8,000 or so, right, of just expenses for which I have receipts. The board would like a stronger policy before it votes on whether or not it reimburses me that money. There's no money that has changed hands. We have finally got a policy together, and the board is, and I hope at the board's next meeting, they will approve that policy and reimburse the money. So you know that money amounts to, and we have obviously a exact detail, so that's since we started, like 1,000 or 2,000 of that is in a case we had 2 buses that were towed and the towing company required cash in order to get the buses out. So I gave them cash. There's another case where we had a holiday party and we got a 10% discount if we paid cash. So we paid cash for the pizzas, and the rest of it is, is like, we needed to get something notarized or send a FedEx, or, I get reimbursed, as does anyone, when we travel between depots. So our trip to work, we have to pay for, but if you go from the Staten Island depot to the Brooklyn depot, you get reimbursed, and the rest of it's that. All of that, perfectly documented, no money has changed hands. That should be a note from me, not from the auditor.
Yeah, no, the problem is getting a management letter when there's 3 years running the same issue.
So we've had some, our board, I think, has made the right decision in, they are city employees and advocates for kids, and certainly they meet once a quarter. They review our financials. They rightly, I think, are prioritizing, I think in a good way, like things beyond, Matt's reimbursement. Matt does fine, right? So it's just taking them some time to get a policy approved.
Okay. And
Can I just come back to one thing, Mike?
Sure,
Mike.
Well,
It's Warren. Yes, just on the non-collateralized and the compliance with the general municipal law. For all the New York State public benefit corporations, which are basically all the component units that you look at for citywide and all state, they have to do a Paris reporting that includes an investment report, and that investment report includes a letter from us as to investment compliance, whether we observed any instances of non-compliance. So those uncollateralized investments that are in the escrow were reported as an exception to the investment compliance requirements of the general municipal law in our report, in that report that accompanied their investment compliance. So we would agree that it's not in accordance with that law, and it was reported as such.
Thank you.
thank you, Mr. Rupo.
Sorry I couldn't be there in person.
Sanibel?
No, close.
Okay, with no other questions or comments, thank you for coming this morning, and good luck on this year's audit.
Thank you.
Thank you.
Next up is the New York City School Support Services, SSS.
Mike, while they're coming in, maybe I should have did this during the introductions, but you might be wondering what happened to Phil Marciano, who was the partner from these entities for a couple of years. He left our firm in May, and since that was kind of unfortunate timing for a lot of June 30th year ends, I kind of came even a little bit more out of retirement and took on these entities as engagement partners. And Jim, who you met, who was at the table earlier, is probably going to come back for this entity. He's going to kind of work with me this year on the entities and take over next year's audit. The year after next is audit for these. So we're kind of rotating them in.
Back to retirement?
Yeah.
Good morning. Could you please introduce yourselves and your titles, and who might be on Zoom helping you or assisting you in the presentation?
Sure, I'll go first. My name is Brooke Jenkins-Lewis. I'm the executive director. Warren Ruple, as you know, is representing us from CBiz.
I'm Vishal Patel, I'm CFO at NYSIS.
That's another thing. Move the things closer because the people on Zoom can't hear you if you're not talking into the mics.
Vishal Patel, CFO at NICES.
John Shea, CEO, School Facilities, New York City Public Schools.
Phil Napolitano, New York City Public Schools.
So we're NICES. We were created back in 2016, and we effectively replaced the old indirect system with the custodial engineers. We provide the custodial helpers for the New York City Public Schools. We employ roughly 6,500 to 7,500 employees, depending on the season. Summer is usually when we ramp up for fill-ins. I think this is the 7th year in a row that we've provided clean, audited financials. There's nothing really to call out unless you guys see anything. And I pass it to you if you guys have any questions.
First, do you have an audit committee?
We do.
And how many members and who makes it up?
So right now, we technically have 3 board members. There's 2 board members that are being added, but all 3 board members are on the audit committee. Generally, when we have a full board, which is 5, we have 3, which includes the representative from DOE, the representative from OMB, and then usually one that's appointed by the chancellor. It's usually a parent or a community representative.
I have a question. I'm looking at the payables and receivables in your financial statements. So I see in 2024 you had a 3.5 million due from the city DOE, and in previous years you had due to the DOE in smaller amounts. And I'm just wondering, so like the 2024 due from, the previous years, there's no sort of similar due from. And I'm wondering what's happening with that, like your cash flow between you and the city.
So basically what happens is we submit a requisition request in advance of us actually spending. It's generally done monthly. And so it basically is just the difference of our best guess versus what the actual spend is every month. So towards the end of the year, it could be that ends up payroll might be higher than expected due to overtime or some events. Maybe some audits that come in that we have to account or accrue for. But that's generally what the makeup is. If you were to look at prior years, we did have due from the city of New York. I think the last 23 and 22 is when we had due to. So it's basically where we have our best guess in the beginning of June what we're going to spend, and there's usually a differential. It depends on which way it swings.
Okay, it just seemed like a big difference for the due from to go from 0 to $3.5 million, which is I don't know, it just seemed like a big change.
Yeah, so our average spend, depending on how many payrolls we have in a month, is anywhere between $60 to $80 million. So, in the grand scheme, as far as the monthly spend, it's really not a lot. Yes, it is between it. Looks like in 23 we had a better guess as far as what that is. But it's really that, our payroll on a biweekly basis is anywhere between $19 to $23 million, depending on overtime and the operations and things like that.
Okay, all right, thanks.
Once again, I think I saw that your contract expires in 28.
Correct, with 2 one-year options.
At
The DOE's option.
Okay. Anybody have any questions or issues? But this is all, back in my day, the school custodians and their staff, or is it just the staff and not the school custodians?
So we provide the staff. The school custodians are still employees of the city of New York. So those custodial engineers manage our staff, but we provide the staffing for them. So we've got the, centralized reporting, centralized payroll, and everything else like that on our side.
Do you guys actually pick the staff, or is that still picked by the custodians?
So generally it's picked by the custodians, but we also have union contracts that we've got to follow. So there's rules as far as transfers and things like that. But generally if there's, nothing in the union contract that dictates that we have to specifically put in specific employees, the custodial engineers are able to pick from 3 people based off them doing interviews. So they do have a choice in it, and they also submit recommendations as well when they go through the process.
And this is for every single public school?
Correct. From my understanding, yes.
How do you monitor performance by the superintendent, the people actually doing the work?
So I think that would go more to the DOE, since we provide the staffing. It's the custodial engineers that I think are more responsible for that aspect.
Yeah, I'll answer it first, and if you have anything to add, please jump in. Custodian engineers, as we mentioned, are still the supervisors. One of the many reasons why we moved to this model in 2016 was to take away the day-to-day responsibilities for things like the HR and management of the staff, but the custodial engineers are still the day-to-day managers. So if there is an issue with one of their NYSIS employees, they would be the ones to write them up. They would be the ones to reach out to NYSIS and start a progressive discipline process. They're still in charge, just like any other city supervisor. It's just that the employees that they're managing are employed by NYSIS.
I was once on the audit committee of the Board of Ed. In those days, the supers were quite something in terms of running shooting galleries and things like that. And I assume part of the reason for this new structure was to better control the way things happen in the school system.
Absolutely. Taking away the custodial checkbooks and the custodial banking and centralizing that budget function and the purchasing of supplies, where a lot of those things that you're referencing were potential exposures for the city, that doesn't happen anymore.
And the actual performance of duties by people somehow is monitored by your organization.
That's correct.
Wonderful improvement.
We think so too. Thank you.
If I could just add, not sure when you were on the audit committee with the Department of Education, but in the
It was a long time ago.
in the 90s, we changed, before my time, we changed from a task-based system to a performance-based system where the principals of the schools essentially are the supervisors for those custodian engineers. So the Division of School Facilities still has a role as the supervisor, but the day-to-day supervision and essentially the custodian engineer rating is done by the school's principal. So that was a big change to our system.
But you had mentioned supplies, so is it the custodian that orders the supplies through the Department of Ed?
That's correct. We give every school a supply allocation based on square footage as the driving factor, and then variable building components. And it's the custodian engineer's responsibility to order supplies. Again, a change from 2016 is that prior to 2016, custodian engineers would purchase the supplies with their checkbook, with operating funds in a joint checking account with the department. Since then, we give them an allocation. They're able to order supplies, but their supervisor, the custodian engineer supervisor, who's the deputy director of facilities, approves those purchases. So again, greater oversight into every purchase that's being made regarding supplies outside of New York City School Support Services. This is a function of the DOE. No.
When was that taken away?
I started in the schools in '99, and my custodian engineer did not have a Jeep, so predates that.
Yeah, what we're talking about is every school custodian was given a Jeep to be used both for personal and business purposes. I was trying to be correct.
Just as a question, so you have a parent on your committee,
Correct.
and so how do they feel about things, how things are going?
Everything that I've heard has been positive. I mean, he sits on the board and he's pretty active. He's actually our longest standing board member since we've had, with the new administration with Adams, that we've got a new OMB rep and a new chairperson. But I believe that it's all positive.
In the basement, right?
Or 1,000 years of stickball broom handles, excuse me. Any other comments or questions? Thank you for coming this morning.
Thank you.
Thank you.
Thank you.
No, I think it was guns.
The next entity is the New York City Educational Construction Fund. So you're down in Florida?
Yeah, but that's not the reason why there's not there in person. I have a commitment for something here tonight, and I made the mistake of joining the board of the community where I'm at. So the board installations tonight, so that I really couldn't miss that. So, and I didn't make enough money to fly private, so I have to be down here.
I'll reach out to Dave.
Yeah, absolutely.
It's like from,
Educational Construction Fund.
Oh.
Good morning. See, I'm doing this correctly, am I not? Okay, great. Yeah, okay. Oh, okay, okay.
Before you start.
Thanks so much.
Excuse me, before you start, I assume that the paragraph that says it's not intended for anybody,
It is intended for you.
intended for us.
Intended for you. No, you, just you.
Okay.
Just you.
Next time, make that plain.
Okay, I will. We will note that for the record.
Good morning.
Good morning.
Just for the record, do you have an audit committee?
We do. We have, our audit committee is actually our board as well, so it's a 3-member board who also serves as our audit committee. And that is two representatives from the mayor's, sorry. All representatives are from the mayor's office, one being the chancellor, the other being the president of the School Construction Authority, and the third being the commissioner for Office of Management and Budget.
Okay, thanks. Please identify yourself with your titles and anybody that's associated with this audit that might be on Zoom for the record and the taking of the minutes.
Correct. My name is Jennifer Maldonado. I am the Chief Executive Officer of the Education and Construction Fund.
My name is Cynthia Wong, and I am the CFO of the New York City Educational Construction Fund.
Good morning, Jim Wilkinson. I'm Managing Director with CBIZ.
Dan McAwee, Senior Audit Manager, CBIZ CPAs.
And another big reason to talk into the mics is for the people on Zoom to hear
Understood. And we have Warren Ruppel from CBIZ.
Yeah, we know Mr. Ruppel.
You know him very well, so. But thank you very much for having us. We always look forward to this meeting every year. I
You
especially
do.
like, I'm waiting for Mark's comments. We're happy to report that the fund did very well this year. Our net operating income increased to $28 million in 2024. That was compared to $22.4 million. Our rental income and tax equivalency payments also increased to $39.4 million. I have to sit like this. Along with the standard increases in our rental income from our projects, our newest project, our 80 Flatbush project, began paying tax equivalency in 2024. The biggest accomplishment that we had this year was our 80 Flatbush program opened to the public in September. So we were able to open 3 new schools, 2 new schools and a D75 program, as well as 2 residential towers, which are the operating income that we use to pay our debt service. These 2 schools or 3 schools are in a building that is considered the first New York City passive house building, which is a new energy efficient model that allows the city's public schools and all city buildings to meet their emission standards in 2030. And it's serving as a model for SCA moving forward on how they can construct buildings that are more environmentally friendly. The residential portion is the first all-electric skyscraper in Brooklyn, and perhaps even New York. I can't remember if that's the case, but it's a spectacular accomplishment. It took about 7 years to actually come to fruition. COVID delayed our opening by 2 years, which, it has with most things, or it did with most things. But we're very proud of the continued work that ECF does to meet the Department of Education's educational needs, facility needs, and we are actively looking for other opportunities to construct more of these programs in the near future. So with that, obviously, a lot of the information is within our financial statements, but if there are specific questions, we are happy to answer any and all questions. I'm waiting.
These are grammatical more than anything else.
I
But
knew it.
if you
I
get,
was waiting for it.
if you get to page 3, you have the fiscal years ending June 30, 24, and 23. So probably you're missing a June.
I see what you mean. Yes, we are missing June. Okay, we will
And
make that
on
change.
page 4, you say the residential and commercial buildings complete for the full 80 flashbacks block. What is that supposed? Something's missing there.
Which paragraph are you speaking about?
It's the next to last, the residential and commercial buildings complete for the full block. So words
Complete, it's basically complete the full 80 Flatbush program. So we'll make the change. We'll make the
think you
change
wanna
to
look at
clear
that.
that up.
I'm sorry to bother you with such little stuff.
It's okay.
Where exactly is the Flatbush block?
So that is on Flatbush, Schermerhorn, and 3rd Avenue. Are you familiar where
Down by
Mark
Junior's.
Morris?
Down by Junior's.
A few blocks north of that. It's across the street from BAM.
Okay.
It's across the street from Whole Foods. So there you go. That's always a landmark for folks. So Whole Foods and Apple store. That's so.
My landmark is Junior's down there.
Now I know it's where the Watchtower is. So.
Bother you with the it's.
Okay.
Grammar.
We'll.
He'll give it to Katrina.
Okay,
We'll
that's
forward it
fine.
to you. If there are no other issues or comments or questions, thank you for coming and good luck on
Okay.
this
Thank
year's
you so
audit.
much. Thank you so much. Have a good day.
Contribution.
The next entity is the New York City School Construction Authority. Good morning. Please identify yourselves for the record and your titles and who might be on Zoom that's assisting you. And go.
Sure. Morning. My name is Steve Maroney, and I'm the Senior Director of Finance at the SCA.
Good morning, everyone. My name is Ewan Wang. I'm the Director of Accounting at SCA. To my right is Jim Wilkinson and our auditors, and Dan McElwee, and we have Warren Rupo on the phone.
Okay. And just for the record, do you have an audit committee?
Yes, we do.
And how many members and who makes it and who are they?
We have 3 members, and the question is, how do we select those individuals?
So we'll have to get back to you on how we select them, but we have 3 members. One is Liz Bergen, one is Dana, and we have Ken as the third individual.
Okay. Please get back to Katrina.
Yes.
And she'll get to the rest of the audit committee. So at this point, I'll turn it over.
Is that Ken Gardner from OMB?
Actually,
No, it's Ken Carpel.
yeah, Carpel.
How come you didn't have the language in yours about this was, this information can't be used except with your permission?
That's
And
interesting.
your other colleagues have that language. I'm just curious.
Are you talking to our opinion?
Yep.
Or I will kind of defer that to Dan and
That must be, I don't have a copy of that letter in front of me.
Well, I can
but,
tell you that I'm looking at the one for the bus umbrella services, and has that restrictive language that it can't be used except with your permission. But in this case, there's no such language. And I'm just wondering,
There should be, so we'll be sure to add it.
no, but it's not here.
we were exempt this year.
Okay. You're right.
It is on the management letter, correct?
Yeah.
Yes, it is, Warren.
Don't panic yet. It's there. Yes.
Okay, great. Okay, so I'll give
You don't have to, we got these fixed. You don't have to hold the button down, as long as the light is on.
Okay, is that okay? Doesn't sound like.
I think the light's off.
Okay. All right. All right. So good morning. Once again, my name is Steve Maroney, Senior Director of Finance at the SCA. So I'll just give you a quick overview of SCA's operations and our capital plan, and then we could look at the financials from there. So the SCA was formed in 1988 as a public benefit corporation, and we're responsible for new construction and rehabilitation of all the schools within the 5 boroughs of New York City. Last June in 2024, we completed our 7th capital plan. That capital plan was valued at approximately $19 billion. And in the last year of that capital plan, we obligated $3.9 billion. So that $3.9 billion went for 16 new schools for $600 million, 300 capital improvement projects for $1.3 billion. And in September of 2024, we opened 24 new schools, creating 11,000 new seats within New York City. So that was a major accomplishment for us. We've now begun a new capital plan starting in July of 2024. That capital plan is valued at $20.5 billion, and it's very similar in makeup to our prior capital plans. We're going to have approximately $7 billion for new capacity projects. New capacity is when we're building a new school or we're adding an addition to an existing school. So about 1/3 of our capital plan is dedicated to creating new seats. Beyond that, we have another program called Healthy Schools, and this is a category where we're electrifying facilities by removing machinery fueled by gas and oil to use clean fuel for heating, upgrading, and modernizing physical education spaces, and creating health and nutritional learning spaces. So one of the big focuses will be electrification projects. So where we're trying to move away from gas fueled boilers, oil fueled boilers, into electrified units. And so we're going to spend about $1.4 billion in this current capital plan on that. Next category, we have our CIP projects. That includes investments in keeping buildings watertight, expanding accessibility projects, enhancing opportunities for all educational programs and infrastructure, for technology projects. So that's where we're really replacing windows, roofs. We're doing all the necessary things to keep our schools functioning for the children in New York City. And then lastly, we have our mandated programs, our asbestos abatement program, our code compliance program, emergency program, wrap-up insurance, prior plan completion costs, and that makes up the final category. And that's pretty much our capital plan that we're in, the 8th capital plan, and that's everything that I wanted to present. So we're happy to answer any questions regarding that, or we could take a look at the financials.
I just have a question, Steve. So you said you're starting you're starting your first year, your 5-year plan, and that starts when? I'm sorry.
We're currently in it. We started it last July 1st of 2024.
Okay, okay. And then the other question I wanted to ask you is that, because I was always confused about this, window replacements. Now, they're really not eligible for capital, right? Because but if you do the whole school, is that how you get it to be eligible?
Yes. You have to look at Controller's Directive 10 for capital eligibility. And as long as you're affecting more than 50% of the exterior area, it's then capitally eligible.
And it's only exterior area? Or is it anything?
What I was just speaking about is only in the exteriors,
Right.
but we have to review it all for capital eligibility.
Okay, so you could do something internal that was broad-based?
As far as upgrading a
Yeah.
science lab
Yeah,
or something
yeah.
internal, yes, we can.
Okay,
Absolutely.
okay, thanks a lot.
Certainly.
I have a question, just, I might have missed this. So are all the new schools going to be all electric, or is that not?
Yes, that is our policy, yes.
So are you able to incorporate solar into this mix, or?
I believe we look at solar, we look at geothermal. Geothermal, yes, thank you. Yes, we do. And we look at all different ways to electrify the school, and then with electricity also.
I do have a question.
Just following that, like, do the schools have emergency generators? Or, like when you say that you're moving all to electric, and like if there was a blackout or in an area or something, is there emergency generators? Because some of the students might need something.
I believe there are. I'm not an expert in that area, but I believe there are, yes.
Okay. Francis.
Oh, thank you. Since you talked about the plan, right? 20 billion, if I recall, is it all in the city's commitment plan?
Yes, it is.
Okay, then you said 7.5 maybe billion for new seats.
7 billion, yes.
Is that going to be sufficient to meet the class size mandate?
Well, New York City just added $2 billion to this current capital plan. It used to be valued around $17 to $18 billion a year ago when I was here, and New York City added $2 billion for compliance with class size reduction. I don't believe it's going to satisfy everything, but it is taking a step in the direction of getting there.
So annually, well, I guess we're going to have one more certification and then somebody else is going to do it. We need to certify whether the city's budget and capital commitment plan have enough resources to meet the class size mandate by state law. We would very much like to, for our last certification letter later on towards the end of the year, to have some sort of clearer estimate from SCA regarding what might the need be for capital commitment.
Okay. We have a capital planning group that works very closely with DOE to kind of lay out our plan. So I can refer this to them and try to get that answered for you.
That's great. Thank you.
Oh, sure. Take a look on page 7, and you say cash is secured through J.P. Morgan Chase and collateralized. Now, I understand you borrowed money from Chase. Is that what you're saying? When you say cash is secured through J.P. Morgan Chase, so what does that mean?
Basically, we have cash that are in excess of the FDIC insured amount. And so as required by the general municipal law, the bank itself has to buy security in order to ensure that the cash is secured with them so that if they have a default, we have a means of getting our cash back.
I appreciate that, but you say here, cash is secured. Is that literally what you just said?
Yes, so JP Morgan Chase secures it for us on our behalf.
You mean, they get you the cash or they collateralize?
They collateralize with the security.
Okay, well, you didn't say that.
Okay.
And it's collateralized by U.S. Treasury notes. Okay, that I understand.
Collateralized in U.S. Treasury notes.
And then the liability, the new building lease.
Mm-hmm.
Okay, that takes care of that one. Then when you get over to capital assets, you have that capital assets are generally stated historical cost or base. What does that mean?
I'm sorry, can you let me know which page?
Page 16, capital assets. It says capital assets are generally stated historical costs or base. I can understand historical cost. What's the base?
It should be based.
It's based, it should be with the D at the end. We're based on contractual terms, so we'll fix that.
Okay, now I don't know something that you use here. What's the half-year convention? I'm not familiar with that.
So that is the amortization we use. Well, the depreciation we recognize on the first year. So every asset we purchase, we take 50% of the depreciation on the first year.
Okay, well, I learned something. Then let's go.
I'm sorry? Yes, and the last year. Yes.
Let's go over to page 17, where level 1, you refer to brokered markets. I used to be in the business. I don't know what that means.
So I guess what we're trying to say here in level 1 is anything that's out there that easily can be marked. The value is determined through a broker. So that's laid out in
Okay, well, it's an unusual way of referring to it. You might think about that.
Okay, we'll take a look at the language.
And then there's some more language. Securities held by the authority are categorized as 11-1 inputs. I understand they're level 1, but I don't know how you characterize them as inputs. Grammar there.
Okay, we'll take a look at that as well.
Oh, let's go over to page 19. Then you say here that securities in lieu of cash retained, the authority can subject to bonds of any political subdivision of the state of New York with a par and a market value. One or the other. It's hard to be both.
We will change it to or, so one of the other, as long as they meet the.
I think that's probably right. And then this is a business issue here. On page 25, I'm looking at the target allocations for BRRRR and NYSER, and there are very substantial differences in the allocations. For example, the fixed income on one is 28% and the other one's 31%. Why should there be that great big a difference between these two funds?
We will have to inquire that. We use the New York City's actuarial for the BRRRR and NYSER, so we'll have to.
No,
get
I
that
understand that, but then it should be roughly the same for each.
I think those allocations might be determined by the boards of the respective pension systems.
I think so, but
Yeah, I think that's how it's determined. They're not determined centrally.
What are those percentages again? Sorry.
These, correct me if I'm wrong, these are
31% in
carved
one
out
and
pieces of TRS and BRRRR's CAFRs.
Yes.
This
Acros.
it's the rates of return expected from the same, for example, in BRRS, the long-term rate of return is expected to be 2%, and NICER, it's 3.30 for the same kind of securities. Little.
We'll have to see what the mix of the fixed income is, because sometimes the mix
Okay.
of fixed income would determine the return, the rate of return.
Then there is the deferred outflows reported at pension expense. And there are huge differences between BRRS and NICERs. Big difference. I'm sure there is, but
Well, the biggest one that is relating between the BRRS and NICERs is related to the actuarial valuation. It appears based on this chart and the chart that they provide us in their valuation report. But we can take a deep dive to look at exactly what in the valuations is driving the difference.
the one that stuck in my mind is in 26, BRRS is 13 million plus, and NICERs is a million.
Correct.
$1.7 million negative. Somebody's doing it. Just looks odd.
So we'll have to
Yeah,
take
Mark,
a look.
these numbers come from the plans themselves, and, you know, to some extent, the component units are relying on the plans auditors to have this information appropriate. And I've seen, you know, swings in these deferred amounts,
Sure, these were
year to
given
year
to.
that based upon gains or, you know, actuarial gains or losses, et cetera. So it's not unusual. It'd be kind of hard for them to figure it out, but they can certainly ask the question.
Similar funds.
Yeah, I can't hear you.
That part of my life I used to deal with.
It would be simpler if we had a say in the components of it, like the investment or the valuation, but this is done
It
as an
just sticks out.
aggregate.
I'll
So,
leave it to you whether you want to look at it, that's all.
yeah, it's an allocation to us, unfortunately, and we have no control over that.
Nope.
Anybody have any questions or comments? Thank you for coming, and good luck in this year's audit.
Good. Thank you.
Next up, I'd like to have a motion to go into executive session.
Moved.
Thank you.
Mikhail, we can stop recording?